Good afternoon, everyone. Thank you so much for joining us, and welcome to the Questrade webinar series. I'm your host, John, from the Questrade education team, and joining me shortly is our very special guest and presenter. Before we get started, let's quickly go through some important notes for the event, along with a quick disclaimer. So today's session will be recorded, and we'll have the on-demand version available next week. If you have to leave early or would like to rewatch an important section, we've got you covered. Keep an eye on your email inbox for the recording. And if you have any questions during the presentation, please type them into the Q&A window available at the bottom of the Zoom interface. Our agents can help answer simple questions throughout the presentation, and we'll be hosting a longer question and answer period at the end of our webinar today. And if you're having technical issues, or if you have general questions about Questrade, please feel free to message our Questrade support agents via direct chat or through the Q&A during the presentation or at the very end. All right, so here's our quick disclaimer. Don't worry, I'm not going to read the whole thing, but please remember that the information conveyed in this webinar is for informational and educational purposes only and does not constitute advice or recommendations by Questrade. Awesome. Now, without further ado, I'd like to introduce our guest speaker today. Surenanthan is the head of national accounts and institutional sales at Vanguard Canada, and he's very passionate about investor education and provides specialized expertise on Vanguard's active and asset allocation products. We're very excited to have Surenanthan here today, so without further ado, I'd love to pass things off for the presentation. Thanks again, and take it away.
Thank you for that, John, and I want to thank everyone for joining the webinar today. I think it's middle of January as everyone's looking at their New Year's resolutions. I think this is a good opportunity to take a second and talk about investing. And based off the poll, I think this hopefully will be useful for the majority of the attendees today. I think we all have different New Year's resolutions. I think my wife's New Year's resolution is that I shave this beard off my face, but I think for the most part, we want to work towards something that helps us with wellness, right? Whether it's physical wellness, whether it's financial wellness, and hopefully this gives enough of a foundation to start thinking about portfolio construction for individual investors. So with that, I'll go through the deck here. The things I want to talk about, while my role right now is head of national accounts, prior to this, I was actually leading our product development as well at Vanguard. So I want to keep this presentation something between 25 and 35 minutes, just to give as much time as we can for questions, because we'd love to interact and see what's top of mind for you and where maybe Vanguard stands on some of the topics that seem to be top of mind for the attendees today. And so the overall presentation, what I want to accomplish is just overall what we are thinking about when it comes to portfolios. What are the building blocks that go into portfolios? What are the nuances that we should consider when we're constructing a portfolio? And what are the options out there for investors at the end of the day? And so it only makes sense to start off with this question of what types of portfolios are there? And really what you'll see even globally is there's two types of portfolios that investors can get into. There's tactical asset allocation and strategic asset allocation. And so what you're also going to get in this presentation is a ton of references to different things outside of investing. The way I think about tactical asset allocation and strategic asset allocation, on the tactical side, it's similar to the early 2000s Ludacris song where he says, "When I move, you move," just like this, right? And so tactical allocation, going back to when I move, you move, it's really trying to predict where the market's going to an extent, right? So you have your allocations to bonds and equity, so stocks and fixed income, and you're trying to predict what's happening to the market. And so maybe you think the market's going to go have a downturn, so you want to go into more fixed income. So tactical has this moving component to it, which of course is quite difficult at times. Strategic asset allocation, you got to go back a couple of decades, I think, to the Police. And there's a quote in one of their songs: "Every breath you take, every move you make, every bond you break, every step you take, I'll be watching you." And strategic asset allocation is similar to that, right? It's this idea that you've set a specific target risk, which we'll jump into. And then over the years, you're just watching it to make sure it's still in line with what your goals are. And you're not going to have this almost innate feeling of making a change. So it's not the when I move, you move. And so that's usually how these portfolios can look like from a high level. You'll have a variety of approaches that fit, and we'll go into what makes sense for an investor. But tactical, going back to the summary, trying to move ahead of the market, and strategic is you're setting it, you're just watching it, making sure it's still in line with your overall goals. And so when you look at that, you have to ask yourself, what goals are you trying to achieve when you have this portfolio, whether it's tactical or strategic? And when we look at this at Vanguard, there's three things that come to mind, right? One is a goals-based approach. What's the easiest way of going to that? It's, I recently had a son, he's 18 months. I'm already thinking about what happens when he goes to post-secondary. So there's a goals-based approach here of, when he turns 18, how do I get enough money to ensure that he can have a career in whatever he chooses to do. We're not sure exactly where that is. I'm trying to get him into more STEM. My wife is more in the arts, so we're trying to figure out what that looks like. But that's a goals-based approach that you want to have. It doesn't have to be 18 years in the future. It could be longer, like retirement. It could be something like a trip that you're trying to achieve. And those goals are a particular thing or outcome you're trying to get to. So whether it's a 6% return, whether it's X amount of dollars, that's one component. Now, the other side of this is an income-based approach. And the quick way of looking at that is you're not really looking for the growth anymore. Maybe you got to a point in your career or your life where you just need some supplementary income. And so there's an income-based approach. This is where you'll see a lot of investors either invest in dividend-paying stocks or they're paying more of their portfolio into fixed income. And so there's this constant stream, that upside. Sometimes the market loves the upside, the flashy new thing. That's not really the objective here. The objective is to have consistent income. But the last one, the risk-based approach, is often the one that we see gets utilized the most. And I think it's because it's the most universal, right? At any point in your life, you have an idea of what your risk tolerance can be. And we'll get into ways to figure out what that should look like. And then you construct a portfolio to meet that risk-based approach. The simplest one is you will hear a lot of pundits talk about a 60-40 portfolio. So what are they saying? They're saying 60% of the portfolios in equities, 40% of that portfolio is in fixed income. So that's a risk-based approach. The risk assets in your portfolio is 60%. This is very similar to a lot of strategic portfolios where you have set an allocation and then you go back and you monitor it. Maybe as you get older or you just don't want to take on as much risk, your appetite changes, that becomes more of a 50-50. And so those are the three things that we look at when investors are trying to construct a portfolio of their own. So we have the main types, we have the type of goals you're working towards. And then the question is, what could you have in that portfolio? There's several things. So I'll tell you right now, the list here is not exhaustive, but these are the four that we see a lot. And I'm sure, as you're a Questrade client, these are four that you have access to within your Questrade platform. The four and the ones that you're seeing more and more, we start off with cash. Especially where we are right now with the interest rate market, cash is a very appealing investment at times, right? You have money, you essentially get paid interest on it. There is this element of a lack of risk that comes with it. Generally speaking, it's backed. It's a good portion of your portfolio from a portfolio construction part where you can use that money should you need it for something else. You have some cash set aside, you have an emergency, or you have something that needs that money, cash can go into that. Now, as you move up a little bit and you start looking at the type of investments, you can also go into single securities or bonds. How this is essentially, and without getting into any names, a couple of years ago, there was a really big EV manufacturer, a little bit of an eccentric CEO. That was something where someone was like, I wish I had stock in this company. And so it's a single stock that you're buying, and you're really taking on that risk of that individual stock or a bond, right? A bond essentially is an IOU from a government or a corporation. These are instances where you're taking on specific risks to one company or one organization. So that's moving up the spectrum. And then you have two vehicles I think have really grown in the Canadian investment space. In the last couple of years, we've seen a lot in the latter of these two, but it's mutual funds and ETFs. And so to take that scenario of buying an EV company and just that one stock, you now have mutual funds that are starting to invest in a variety of topics. And why you would want to do this is it kind of diversifies your risk. So what do I mean by that? You're not having that one risk. Let's say that CEO decides to tweet a little too much and the stock comes down. You don't have to worry about that as much because you have far more options within that mutual fund or ETF. And the difference between the mutual fund and the ETF really comes down to a few things, but it's really how you can trade it on a security and just your overall liquidity between the two of them. But for a lot of investors, setting up your portfolio it makes sense to have mutual funds and ETFs really because it gives you access to so much more without you having to monitor every single name or security. So that's kind of what you can look at when you're thinking about constructing a portfolio. And so maybe I'll stop here, John. I don't know if you want to jump into some of this and we can go into some more details on this.
Sure thing. Thank you so much, Surenanthan, for that fantastic intro for everybody. I think we've all learned a lot about the different kinds of portfolios and maybe some of the investments that can kind of make them up. I'm just going to launch maybe one more quick poll for the audience, just out of curiosity to see what kind of investing products the audience has maybe bought or sold recently. So this can be ETFs, like you mentioned, mutual funds, stocks, US stocks, Canadian stocks, maybe even options, GICs, or bonds. So I did put up a quick poll here about all the different investments available at Questrade. So feel free to toss in your response there before we move on. And we can see ETFs are very popular. They're kind of the backbone of a lot of people's portfolios, but we still see a lot of mutual funds, a lot of individual stocks in there as well. And GICs are very popular, maybe with the interest rates right now.
Yeah, no, this is good because I think it kind of leads to the next part of the presentation, right? The pros and cons of single securities and cash. And based off what you're showing me here, it seems there is quite a bit of individual stocks as well, right? And so I think when we look at this from a pros and cons perspective, John, um, the pro is a very easy one, and I think it's one that I can vouch for because I own single securities myself, right? You would think I'm at Vanguard, I'm at an asset manager that's only managed money. That's not entirely true. There's certain things that interest me that make sense. The big pro, of course, is that uptick, right? Like you always hear about. There's always a neighbor of a neighbor or a friend of a friend who tells you about this company they once bought that's now worth 20 times more, right? There's an opportunity there where of a pro that the upside is quite unlimited, right? And when you think about some of the big names that we know now that you want to buy something and you need it delivered in a couple of days, there's a place you can go, and that stock has done quite well over the last little bit. The other pro, I would say, from single securities and cash is, as an investor, you have entire control, right? So you know exactly what you're purchasing. You want to have this and this in your portfolio. You have overall the utmost agency to ensure that. Now, the other side of this conversation when it comes to single securities is the massive con that you have is there's a lot of risk in there, right? And so I noticed earlier on a lot of people had they started investing in some of those retirement accounts, whether it's their registered earnings, RESP, RRSP. So you're working towards a goal. I think the old adage, you don't want to put all your eggs in one basket. That's really what the main con that you have around single securities. The other part is the due diligence, right? The amount of time and effort to go and buy securities, it's quite a bit, right? I'm sure there's ways you might have a Reddit forum where you go in and someone's suggesting you a stock, and maybe that's what makes sense for you as an investor. But the amount of time and effort that requires to figure out exactly what you want to purchase, it is a cumbersome process. And as we're, like we said, start of the year, we're looking for investing. My goal is to make it as simple as possible, right? And so how can we do that? And a lot of times that's where a pooled product like an ETF, which a lot of the audience currently uses, really comes into play. Now, cash, spend a little bit of time on pro and con cash. Cash, the beauty of it is cash. We know what it is. It's tangible. I made a ludicrous reference. Maybe I'll take a Wu-Tang reference. Cash rules everything around me, right? There is very much a tangible use case here for cash. And there's that safety net, right? That security that you have. Now, what I would say the biggest con, of course, in cash is, and I'm sure some of the audience can relate to this. Sometimes when there's a lot of decision points, you get this almost paralysis by analysis. When do you put that cash back to work, right? Can I figure out the exact right time? And I can tell you, it's more or less a futile attempt, right? Trying to time the market has never really worked out. And there's a saying, it's time in the market, not really timing the market, that helps you get to your end goals. So if you're looking at cash as a place to invest long term, I think that's a con. If you're looking at cash as a place for liquidity or a small part of your portfolio, that makes a ton of sense as you're moving towards goals, right? I have a coworker, he's got a son that he wants to get out of the house. Hopefully his son buys a house of his own sometime soon. It's a good time to have cash there because he has a very short-term goal in mind. So that's where the pros and cons of single securities and cash look like. So
That's perfect.
There's
And I think you hit the nail on the
ample
head there.
opportunity, but I think it's to consider it from the context of an overall portfolio, right?
Absolutely. And I think you definitely hit the nail on the head, whether it's the potential appreciation of the single securities or maybe the simplification of some of these ETF or mutual fund products where it is all in one and you don't have to do that due diligence. You don't have to do that research. Just a quick tip for the audience, stay tuned. Probably in March, we're going to be doing a nice research webinar. So if you are more interested in how to research those individual stocks, keep an eye out for some more invites on that. So I'll pass back to you, Surenanthan, for the rest, and then we'll pop back on for the Q&A.
Perfect. Yeah. And I think the other thing, John, it's worth just tackling a little bit is, cash looks very attractive right now with interest rates. It also looks a little bit attractive because of what happened to bonds a couple of years ago, right? So 2023, really big interest rate hikes. Well, I don't want to make this an economics webinar. We're not going to go into the factors that led to that, but what it has happened, when you look at how bonds are priced, it's negatively correlated to where interest rate movements were. So high interest rates, bonds came down. And so people are looking at bonds as maybe they're a little bit more risky than they were in the previous years, right? At Vanguard, we looked at this, right? What it looks like for a long-term investor. And you can see on this chart here, obviously that first year, that this magenta pink line, what you'll see that first year after a 200 basis points increase, bond prices obviously went down. Now, when you're looking at a ETF or a mutual fund, but let's maybe stick to ETFs here, you have a lot of bonds in that portfolio, right? And so while the first year impact was down, as you're adding more and more bonds into that portfolio, what you end up having is you're reinvesting at higher interest rates. So if you look at the overall return for a bond, it's the price of the bond, but also the coupon, the interest payments that you're getting. As this goes on and usually tied to the overall maturity of the bond, what we'll see is as you get to the sixth, the seventh, the eighth year, generally speaking, investors are better off with higher interest rates. So it's obviously tough if you were in bonds in 2022. Like, I'm sure this isn't going to be enough solace for you to feel better, but as you stick to it and get into the market and continue to have your fixed income as a part of your portfolio, it tends to pay off. And this is where you marry it with what I had spoken about when it comes to timing being very difficult, getting out of fixed income because you had a bad year and sticking in cash, you actually don't get that pickup. Because when interest rates go back down, you're not going to be able to reinvest it at the rates you would have been able to lock in with fixed income. So it was just something I wanted to just raise as we're going through this deck as well. Now, earlier on, I mentioned what are the tools that you can have when building a portfolio. And I know Questrade has a few of these as well. The first one is really around an investor questionnaire. It gives you an idea of what you're working towards, your goals, right? So what's your time horizon? That matters a lot. I would say, generally speaking, and this isn't for everybody, but generally speaking, the longer your time horizon, the more risk you can, you have the ability to take on a little bit more risk, of course, because there's the opportunity to make back anything that you may have lost. Your risk tolerance also plays a big part of it because you can have a long time horizon, but you may feel very anxious about your investments. And maybe that in itself puts you into a more conservative type of portfolio. But also, I tell people all the time, whether I'm talking to advisors and investors, there is this willingness, of course, that matters. That's your time horizon, your risk tolerance, but there's also an ability, right? We all have to remember you might have a willingness to take a lot of risk, but your financial situation may not warrant that risk in your portfolio. So I think a questionnaire really helps figure out what your asset allocation is. There's also a bunch of rules of thumbs that you're going to get into the asset allocation world. There's the right way of cooking rice, but sometimes as you just put your index finger in, once it gets to a certain level, that's what you'd know to cook your rice. And that's kind of what this is a little bit. The most popular rule of thumb when it comes to asset allocation, ETFs, or asset allocation in general is people would say, take the number 110 and subtract your age, and that's what your portion should be in equities, right? Now, that is a very broad way of looking at it. I would probably say the investor questionnaire makes a little bit more sense because it's personalized, but that's kind of where, if you're trying to get into the market and you don't want to overthink it, that's a good option. Once you do that investment questionnaire, I think this is where single ticket solutions have really taken off in the Canadian landscape, right? And fortunately for me, I was part of the product development team that was able to launch some of our products or single ticket solutions, but they solve a lot of the thinking and the worrying around building a portfolio instead of going and figuring out what portion you want in fixed income versus equities. And then within equities, do I want the US? Do I want Canada? Do I want emerging markets? What are emerging markets? So these are the questions you might have as you're investing. I think a single ticket security just has all of that together. So you have one portfolio, you're buying one thing. You remind yourself, I get paid on Friday, on Tuesday, I'm buying this. I think that's really a tool that's helped investors. And we've seen quite a bit of an uptick here at Vanguard and obviously through Questrade itself. So these are the tools that, I would say you would want to explore as you're considering to build out your portfolio. Why that matters is this chart, right? There's a lot of information here. But what we've done at Vanguard, whether it's here in Canada, whether it's our colleagues in Australia, the UK, the United States, what we've looked at is your asset allocation. So what I mean by that is what portion do you have in equities? What portion do you have in fixed income? And see how much of your return is explained by just that, just being in equities and being in fixed income. And what we've noticed, regardless of where you are in the world, somewhere between 80 to 95, let's say, percent is driven by your asset allocation. So just being in equities in itself, just that first step of finding a single ticket solution will drive a lot of your returns. It takes away that due diligence. Okay, do I have to buy this stock? Do I have to buy that stock? That conversation gets removed. Now, of course, there's a 20 to 5% likelihood of being explained by individual stocks or individual names, but it's the old 80-20 rule, right? If you can accomplish a lot of it with a single ticket security, it really allows you to have the rest of your mental capacity to do other things in life, right? I don't know if this is the most fun thing. I work in asset management, so I would have to say I have a level of passion into investing, but it's a lot of work and it's a lot of conversations that you need to have with your family, and sometimes it might just be easier to have a single ticket solution just to get you towards your goals, and you can spend your time doing what you actually love to do. So I thought this was an increasingly important stat that we want to bring out there, that just getting a questionnaire done or getting a single ticket security really gets you most of the way there towards your goals. So for all of you who've jumped on and said you're at the starting point of your investing career, there's quite a long road, but this gets you onto that road faster than having to do it all by yourself and do the due diligence. So it's important to just consider as you're constructing your portfolio. Now, the other things that I want to talk about is, I mentioned Reddit to an extent, but what trends we're seeing around portfolio construction. At Vanguard, we spend a lot of time on all these inputs, but what we're coming up against at times is just I would say the big leap in technology, right? So investors now have access to information more than they've ever had in the past. That leads to some of that Reddit, GameStop era type of information as well, but it's also overwhelming from an investor's perspective. Someone's telling me to buy this, someone's telling me to sell this. There's just so much information. That's that paralysis by analysis component of it. So that's worth exploring. The other things that we get is, I'm a Canadian. I love to buy Canadian securities. How much should I have in Canada? So we've done some work around that we'll explore. And then what else is happening around from a core to explore situation? So when I talk to advisors and portfolio managers, of course, they take a core and explore strategy. For a lot of individual investors, that core really does a good job of having them invest in the market. And so that's where single ticket solutions really come to play here. And then outside of that, what you get is non-traditional investment. So you probably heard me a few times speak about equities and bonds. There's other things to consider in your portfolio. Like most things in life, I think the attention tends to go to the extremes. No one wants to talk about a 60-40 portfolio for the most part, because it's not as, excuse my language, but it's not as sexy as some of the new shiny objects. And so you get a lot of private equity, private debt, alternative investments. The pessimist in me will say a lot of this is just people trying to push certain products towards you, so it's a higher margin for them. I think the other part is this part of the investment pool, whether it's alternatives, private equity, private debt, and real assets, for a lot of investors, it's really hard to obtain, right? I think if I can own 7 Toronto houses, I would. with the way Toronto prices are going, but it's not as easy to invest in as well as an ETF that you can buy with as little as $25. So I think there's that component of it. There is a use for non-traditional investments, but as I showed in the previous chart, your asset allocation at a high level will explain 85 to 95% of your return variability. So focusing on something with a low cost basis is probably the first step that you should consider as you're constructing your portfolio. Which ties to my last point here around, we jumped right into who I am and we didn't really speak a little bit about Vanguard. Our entire foundation of Vanguard is just low cost. I think the amount that you pay towards investments takes away from your end outcomes and your end retirement goal. And so minimizing costs is an important concept of constructing a portfolio. And sometimes what you see in these non-traditional investments, they don't really have a Vanguard in that space to lower the fees. And so you'll have them in your portfolio, but it tends to be at a higher cost. So with that, what are the things that we should think about when you're starting to look to invest? There's a lot here. I don't want to jump to each one individually, but I would say asset allocation based off everything I've shown you so far and just the starting point is really where you want to get to. I think a questionnaire gets you to that point, figure out how much needs to be in equities, how much needs to be in fixed income. And then from that point on, I would say investment monitoring is your level of comfort. If you're somebody who has to look at your investments every day and you get worried about it, maybe stop monitoring every day, right? Yeah, think about you have to tie it back to your overall outcome. If this is money that you're putting away for retirement and retirement's 30 years away from now, it may not be the best for you to look at it every single day. So have that in mind. And then just keep to your goals because your goals change, right? 5 years ago, my goals were vastly different than they are now that, I'm married with a kid. And so that's an opportunity to make sure that you're sticking to what you want to get to. Because all of this, at the end of the day, is working towards some sort of level of security, something that you can bank on once you're done working, or even just to supplement your current working income. Now, I don't want to spend too much time on this chart here talking about home bias. What I can tell you is we looked at what is the quote unquote optimal number for Canadian securities, whether it's equities or fixed income. And what we saw is the optimal number was 30% for equities and 60% for fixed income. And this type of thought leadership flows into all of our products. So you'll always see consistency with Vanguard. When we construct products, we want to go based off of the academic research that we've done. The simple story here is why we landed on that is it was the number that lowered volatility. So how much your portfolio moved up and down. If you had too much Canadian equities, what you ended up having was a portfolio that was really driven by the banks, the telecoms. We know about this. I refer to them as the Canadian cartel to an extent. They're very much closed off sectors that you'll have a lot of exposure to. And so as they move up and down, your portfolio moves up and down. Now, if you had far less than 30% to Canadian equities, what you then get into some of the other tech sectors that you might see. So think about the US, for example, it's very much driven by tech. And if you had less than 30% equities into Canadian equities, you would get a lot of that volatility that we saw in tech, where Canadian stocks tend to be more value in nature. And so that helped us out to have a more diversified portfolio. Because that's really what we're trying to get towards. How do you get a portfolio that isn't as volatile for you? And these were the numbers that we landed on based off our research. So we talked about stocks, mutual funds, ETFs, really what the differences are. I don't want to spend too much time here either, but what I would say is when you're looking at mutual funds and ETFs, really what are the differences? I think from a vehicle perspective, it actually is very similar from a mutual fund and an ETF. From an asset manager's perspective of how we construct it, the difference for you as an investor is how you can trade it, right? It's a little bit more liquid when you're talking about ETFs than mutual funds. The other part, generally speaking, that we see is ETFs are passively managed. In other words, they follow a benchmark. And so if you have the S&P 500, we buy all 500 of those names, whereas a mutual fund is actively managed for the most part. And so you're going to get a little bit more concentration. But with that active management tends to come higher fees. So if I were to look at this from a fee perspective, stocks, really it's just the fees to trade them. ETFs have a small minimal fee, whereas mutual funds will have a little bit of a larger fee there. So that's kind of what you'll get with an ETF. It's the liquidity of a stock but the diversification of a mutual fund. And that's, I would say, the best marriage of those two considerations overall. So there's been a lot of conversations, I would say, around ETFs and passive investing. Selfishly, I think it's great because obviously Vanguard is an 8 trillion USD firm that has grown quite a bit with passive investing. And we're looked at a pioneer here. I think a lot of the reasons for that is as you're getting into the industry or getting into investments in general, passive is just something that's easy to understand. You want market return, so let's go ahead and get market return through an index product, and that's led to a lot of growth in passive investing. Also, what we see is this idea of a zero-sum game theory, right? And so what does that mean? It essentially means if someone wins, someone loses, right? And so instead of having to combat someone else and getting that win or loss, just be down the middle. I think that's where you get when it comes to passive investing. And then the overall benefits is lower costs into your portfolio, easier to implement now with ETFs. And then it's something that you can construct in a way where you can just constantly purchase and reinvest on an overall basis. So I think that's really what's driven a lot of talk track around passive investing overall. But what I can say is, it doesn't always end at active or passive, and there's a conversation to be had here. So maybe I'll pause, see if you have anything to say, John, and then we can just do the last couple of slides before we open up to Q&A.
Certainly. Thank you so much, Surenanthan. That was really valuable. And I think definitely the conversation around active versus passive is a big one for a lot of individual investors, right? It comes down to a lot of different things, what your risk tolerance is, goals, your time horizon, how long you kind of need to invest for. And at the end of the day, how much research you want to do and how much legwork you want to do on, whether you're looking into individual tickers or even just comparing different ETFs, different mutual funds, kind of deciding what that best asset allocation is for you. So, like you mentioned, I think that investor portfolio questionnaire is probably a really great way to start. We offer one at Questrade if you are opening a Quest Wealth account. That helps you kind of determine whether you're looking at something more conservative or something more aggressive for your goals. And Vanguard definitely offers the same as well. If you go to vanguard.ca, it's relatively easy to find that individual portfolio questionnaire there as well.
Perfect. So as I jump into this, right, John, around active and passive, what I can say is I mentioned we're $8 trillion overall. We have $1.5 trillion in active as well. And so I think we take a unbiased view on this. You see a lot of active shops that will only tell you to buy active, or you might see people say only buy passive. What I can tell you is when I used to do product development or led that team, I never attacked this from an active or passive or a mutual fund ETF component. Really, to me, it comes down to high cost versus low cost, right?
Yeah.
If you can find something at a lower cost basis, I think overall you'll be better. So when we looked at our success in this space, we talk about talent. You need to have good portfolio managers. It's a good old saying, we have good players, they have good players. Everyone's going to tell you they have great talent. It's really hard to vet that out as an end investor. But what isn't hard to vet out is cost. And what I like in this too is I think I'm in relatively good shape, not the greatest shape. I could probably clear one hurdle if it was 6 foot. That second hurdle becomes a little bit harder. The third hurdle, there's a good chance I'm going to trip, John. But if you gave me just 1 foot hurdles, right? I'm going to clear that with relative ease. And that's really what it comes down to when it comes to active investing as well. Managers with higher costs, you're going to have to take on a little bit more risk to overcome that cost to have a positive return. And that is what tends to lead to problems when it comes to active investing, because you don't want to take on risk for the sake of outpacing your costs. So if you can keep costs low, that is very much the number one determinant when it comes to overall performance in active, is around keeping costs low. The second thing is patience. And this kind of goes back to a little bit of an ETF or a passive investor, where if you were to buy and sell all the time, going back to when I move, you move, it's really hard to predict that, right? And so I think having conviction, doing a lot of due diligence and picking a certain stock that you want to have over a longer period of time, that's what leads to long-term performance. We've noticed managers who constantly turn over their portfolio will tend to underperform because there's costs associated to doing that, right? And then there's this idea of trying to chase a trend, which is really, really hard. So I think whether you're an active investor or a passive investor, the one thing that needs to be thought about is a long-term view on the market, right? You have the long-term view and you do it at a lower cost, you'll be able to find success in both those type of investing. So the thing I would say is if you're trying to blend them together, we created this chart. Ultimately, if you're comfortable with having better returns than the market, but also comfortable with having worse returns than the market, right? Because it's that zero sum situation. Maybe you can include a little bit more active, that you have that active risk, is how we've coined that, right? But for someone who just wants to be part of the market, I think passive makes more sense here, where you just want to have the market return. If you're in between, you can find an opportunity to have a combination of active and passive. A lot of portfolios that we see is very much that. And so based off even what you had sent earlier, John, having ETFs and single securities, there's a little bit of active and passive there as well, right? And so buying individual securities is that. So generally speaking, you're going to land on a mix between an active and passive. My only recommendation is to do it in a manner where you're keeping costs as low as possible, and there will get you the best chance to get your overall investment goals. Now, the last thing I want to touch before we open up to questions is there's been this debate, lump sum versus dollar cost averaging. So what does that mean? So if you have some money, you're sitting on some money, should I invest it all right now? Or should I invest a portion of it right now and then another portion of it next week and the week after? So I'm averaging in that money. We did some work on this, right? So there's numbers here on this slide. What I would tell you is I think the one line headline is simply, if you have it, invest it, right? So what we've seen is if you come into a lump sum, you're going to outperform dollar cost averaging about 70% of the time if you just were ahead and invested. And part of this goes back to, what we were talking about, John, of trying to time the market. Holding off a week to invest is not information that you really have any real insights, right? And so what we've noticed is just putting in your lump sum will outperform dollar cost averaging. What we've also noticed is the inverse of that. Instead of holding on to your money every week and then growing into a lump sum and then putting it in, that doesn't make a ton of sense either. So if it comes down to, if you have it, go ahead and invest it. Obviously, where cash is right now, there's this attractive nature of investing in cash. But even when we look at both lump sum investing as well as dollar cost averaging, it's outperformed cash, somewhere to the tune of 70% of the time. So take away that analysis. Don't get paralyzed by it. I think this is something that has historically been a good rule of thumb, I would say, that investors should look at. So I think with that, we've covered a lot, right? So what type of portfolios are there, how you want to construct them, what you could use to construct them, and the goals you're working towards. Hopefully, there's quite a bit of insights for the audience. And with that, I'll probably pause here and see what questions we might have.
Really appreciate that, Surenanthan. Thank you so much. I think just to kind of echo back to that dollar cost versus lump sum, I've been personally burned in the past by trying to time the market, trying to find that perfect time to put the lump sum in. And over time, just anecdotally, what I've experienced is sticking the course, being patient, and really dollar cost averaging your way in. Just kind of regular contributions is the way to go. It's not 100%. There's that 70% chance there, but statistically, you're better off staying the course and sticking with your original investment plan. And yeah, we've got this quick disclaimer on here as well, just from Vanguard side. And we'll leave that up for a couple of seconds before we kick off the Q&A here. Maybe while I take over the screen share, I'll take this time to also quickly introduce my colleague Adam, who's joining us from the Questrade studio, who's helping out on the Q&A as well. And me and him are going to be kind of reading back some of the questions, and Surenanthan and the team can help answer them for everybody. All right, just bear with me one moment. We do have a lot of questions, so just ahead of time, I don't think we are going to be able to get to every single question, unfortunately. We've got 1,800 of you in the audience, so thank you so much for tuning in today. Let's start off with a couple of the ones that have been here with a lot of thumbs up. Maybe kind of going back to the conversation around US assets, maybe some of that home country bias. Can we talk a little bit about currency hedged ETFs or currency hedged products in general, Surenanthan? So let's say I'm a Canadian investor. I want to invest in the S&P 500, and there's two options available to me. There's the strict US dollar one, and then there's a Canadian currency hedged version. Why would someone choose one over the other?
Yeah, that's it. That's a great question. What I'd say, I'll give you our thought and stance around currency hedging overall, right? Because it's a little bit different between equities, so stocks, as well as fixed income. So What I can tell you is over a longer period of time, currency actually has a net zero effect. So what do I mean by that? Whether you hedge it or not hedge it over 30 years, you're probably going to end up roughly in the same place, right? Because currency can go up or down. Um, if you're looking at the role of equities and the diversification that you can get by investing in different markets, currency is an additional factor to that diversification. So we would say for equities over a longer period of time, you probably want to have it unhedged, right?
Mhm.
This is assuming, John, I have no insights on where the market's going to go, where the dollar is going to or not. Overall, I think best practice is to leave it unhedged so you can actually get the full diversification of
I think that's really sound advice there. I mean,
equity
thinking back
investing.
to currency
On the
exchange
fixed
rates.
income side, currency, like everything,
Oh, sorry. I
yeah,
think I might have been lagging
it's
there
hard
for
to
a
predict.
second.
No worries. No, I think that's entirely. It's really hard to predict. It's one of those things. Now, on the fixed income side, currency, similar to every other thing that's into your overall return, is a risk, right? It is a variable. So on the fixed income side, understanding the role of bonds is to be that protective part of your portfolio. We would say remove that risk from your portfolio, right? So you still get the diversification of being in different interest rate cycles, but you don't have to worry about, being in the US dollar, or let's go one step further, being a Mexican peso bond, and all your returns got blown out because of the peso's movement, right? And so from a fixed income perspective, we would say currency hedging makes a ton of sense. But from an equity perspective, unless you have a strong preference to be tied back to the Canadian dollar, it'd be worth exploring just having an unhedged version there.
It's really sound advice there. I think, there's pros and cons to each. And I think at the end of the day, it's going to depend on your individual risk tolerance, your goals. And it's really hard to predict currency movements, just speaking from experience, even just Canadian versus US dollar. So when you're thinking about global exposure, that's another one thing to consider when you're going for those emerging markets, ETFs, or anything like that as well.
Yep.
So let me see here. I'm just going to scan through for a good question, unless Adam, maybe you've spotted one before I have.
Yeah, so I do have a question here, and I'll start off with this one. I am paraphrasing the question a bit, but essentially the question is there a way to see the allocation of a stock in an ETF? So that is a good question. Usually when I've done this, you can quickly just go and search up the ETF, and one of the first links is always going to be something just providing a lot of the information. You can see all the holdings. But essentially there is something called an ETF fax, and for mutual funds, it's called a fund fax. And essentially what it is inside of there is all the information, the holdings, the percentages, and you can also see the fees that are for the ETF or mutual fund. So this is also where you'll see the comparison. If you ever wanted to compare the two, there is a lot more, there tends to be a lot more fees in mutual funds being actively managed and for other reasons. But that's where you can see a lot of information about all the ETFs that you're looking for.
Perfect. And maybe, Surenanthan, any resources on the Vanguard side when we're comparing ETFs, anything you might suggest for, investors who are looking to compare like management fees, for example, kind of looking between different funds, maybe some resources and places to go for that.
Yeah, we do have a tool on our website that kind of you can, to me, what Adam was saying as well. You put two ETFs in, and you can compare the fees between one or the other. You could also see what that impact could look like over a longer period of time. Um, I would say as an investor, really try to dig in deeper on the potential people that you're investing with, because our website, you're going to have all that information. So if you want to know how much one of our ETFs holds in stocks, you'll be able to look at that on an ETF basis. Now, when you do these comparisons, what I would say, John, is they stick to the high level facts. So you might not get to that level of detail, but every single fund, every single ETF that you find, whether it's ours or someone else's, there'll be a page dedicated to that where you can go and see exactly what is being held and what percentage is being held as well.
That's perfect. Yeah, I know me personally, I always look at the holdings and the allocations, and that's something to consider when you're maybe, not advice here, but when you're considering multiple single ticket investments, making sure, if you want to avoid overlap, for example, so you're not holding the same thing with both ETFs.
Yeah.
Let's see here. Just going to scan through. I think this question has come up a lot with different variations of it from the audience around Bank of Canada and US Fed interest rates. It's a very hot topic. It's been quite a bit of a roller coaster over the last couple of years, ever since COVID. And we've seen interest rates rise to, I think today, this morning, Bank of Canada held around 5%. So that question kind of leads into, should individual investors maybe be considering this more actively today than 5, 10 years ago? Should people be kind of potentially actively managing their portfolios, maybe considering the effects of interest rates a lot more on, let's say, their fixed income holdings, the bonds you mentioned earlier. Any kind of commentary, tips around that, kind of how to navigate these uncertain waters?
Yeah, what I would say, there's a few things, because this question go several ways. I think the question is well positioned around where interest rates are where they are right now, right? So for a lot of investors, younger investors, yeah, don't want to date myself. I think for a lot of younger investors who got into it, they may not have seen this type of world, right? And so it's always been low interest rates, always buy securities or buy equities because that just made the most sense, right? I think the ask that you would have as someone putting a portfolio together is having your equities do a bit more, because you can get a little bit more from fixed income now, right? So if you're taking on a little bit more risk, generally speaking, you would want a lot more return than we had asked in previous years. So when you look at a lot of places, they would say their portfolios that used to be 60-40, so 60% equities, 40% bonds, are looking more like 50-50 or even 60-40. So there's that component of that. So there's the current dynamics in place. Now, the risk I would call for is, if your investment horizon is 30 years down the line, I don't think that's a consideration that you should really have, because you're aiming for 30 years of investing, right? And so I wouldn't change my portfolio unless my personal circumstances have changed. Because going back to the timing of the market conversation, the likelihood of predicting these macro trends is very low. And if you were able to do them with a high level of accuracy, John, I love this webinar. I probably would be on a beach right now. I wouldn't be sitting here talking to you, because that's the type of return that you would get into it. So that's the one thing to consider as well. So summarize, fixed income looks very attractive where interest rates are right now. Equities, they're going to have to do a little bit more to be part of your portfolio. But if you're a long-term investor, I wouldn't make any drastic change unless your personal risk tolerance has changed.
Absolutely. And that's really sound advice there. I think it all comes down to your individual risk tolerance and those goals you set out originally. Don't go changing your goals just because of a headline. And I think I can count on, two hands the amount of headlines that have gone either way. People predicting that rates are going to go down this year, rates are going to go up, rates are going to stay the same. Even if the professionals can't guess, then kind of how can we guess that? So it's really great advice there. And I think to kind of stay the course.
Yeah, I think unfortunately we're getting into a world where everyone wants to have a hot take at times. So it's sometimes I'm not sure if I'm watching BNN or ESPN. I think that's the world that you're slowly getting into here.
Yeah, it's all about those viral clips. So maybe leading into one more question here, one that I've seen here in the audience, and it's actually come up a couple of times in some of the personal finance subreddits that I follow. And that's kind of this conversation around where to invest when everything's at an all-time high. So we see all-time highs quite often, and this scares some people, maybe first-time investors especially. How can I invest my money if everything is the max, if it's never gotten higher than this? I think personally, just my anecdotal thoughts on that would be, there's always going to be all-time highs. If we look at the S&P 500, the TSX 60, it hits all-time highs every single month, almost, multiple times a year. So there's never going to be a perfect time to invest. And just because the market's at an all-time high shouldn't necessarily scare you from getting started with things. But welcome any additional thoughts there.
I think that's correct. I think when we hear all-time highs, we're afraid that we're going to come down this mountain, right? So I think you have to take that all-time high and then marry it to a trend. Why do stocks go up in time? I think inflation's a part of this. So as companies are more productive, as costs are passed off, stocks have been historically the greatest hedge towards inflation. Mm-hmm. Long-term inflation, not what we've seen over the last couple of years, but long-term inflation, right? And so if the trend is also this upward direction, you got to keep that in mind. This is not breaking an all-time high that happens once every 10 years. If the trend is constantly moving in one direction, I wouldn't be overly worried. I can completely see where the person's coming from, and it might have a style of investing in there a little bit. That person might be more of a value investor, and I think you can explore some maybe value names if you want to have something that isn't at an all-time high. But aside from that, I would say the trend also matters as much as the headline stat of all-time highs.
Definitely. It's all about the overall market trends, I think, at the end of the day.
Yeah.
And that's going to be impossible to predict. Thank you so much there. Maybe one more question for me before I hand to Adam in case you've got any good ones here. And this one's maybe just to clarify for the audience. So when we're talking about fixed income, that can mean a variety of different investments. We hear this talked about a lot. Equities are pretty straightforward. Equities are usually going to be stocks or an ETF or mutual fund that primarily holds stocks. So you've got a small piece of ownership in the company. Think about it as owning 0.00 many zeros percentage of Apple, let's say, or a company, anyone that you could name. Whereas fixed income is going to be investing in things like government bonds, GICs, potentially preferred rate shares. So these are slightly different than equities in that you don't necessarily have an ownership piece. It's more of an IOU. So fixed income can be great when interest rates are high, but interest rates don't always stay high. And it's really tough to predict where they're going to go. So just kind of clearing that up for the audience. So fixed income, generally we're referring to bonds, GICs, maybe ETF products that contain bonds as well is a very common one to look into for fixed income. Just because buying a government bond is pretty tough for the average investor, it's tough to go pick up, $100,000 bond from XYZ province or XYZ corporation.
Exactly. I think the transaction costs would be quite high too. Yeah, I think that you did a great job of summarizing it. The way I'd look at it is if your buddy's opening up a lemonade stand, if he takes $5 from you with the promise that you're going to give him that $5 back, that's a fixed income investment. But if he gives you $5 and then every lemonade you sell, you get 10 cents of it, that's kind of your stock, right? It's you're part of this ownership of the company going forward versus I just want my money back once you started making a ton of lemonade.
It's a great analogy.
Yeah, and it's kind of like you're always on the other side of, or tend to be when people are using credit cards and using line of credits, things like that. The person on the other side essentially is having that fixed income, but you're the person paying the interest. So when you purchase that fixed income yourself, it's kind of reversing it, and you're getting that interest. Another question that was popping up, actually really quick, I think it's been covered, but just in case, because I saw this question recently. The MER, it's a management expense ratio, and Vanguard doesn't have one, but it depends on the ETF that you're looking at. So the ETF, depending on what it's made out of, every ETF is different, so they're going to have different management expense ratios. So it depends on what you're looking at, and that's when you want to go back to the like Surenanthan was talking about before. You can go on Vanguard and find and compare those fees. You can also look on the internet, Google and stuff, and you'll find a lot of information about the ETF if you search it up. But the other question was, what are the liquidity differences between a mutual fund and an ETF? So essentially, ETFs are similar to stocks, how you can just trade them and sell them within the same, buy and sell within the same day. So it gives you that advantage of just being a little bit more free. Whereas with the mutual fund, they're traded once per day, and it's at the end of the day. So you don't really get to choose your price like that, because it's at the end of the day, you're going to get that price at that time. But that's the differences, one of the bigger differences when it comes to liquidity between ETFs and mutual funds.
Perfect. Thank you so much, Adam. And just a quick reminder, we do offer basically all the products that I showed on the poll earlier. So whether you're looking for, individual stocks, Canadian, US, ETFs, Canadian, US, mutual funds, ETFs, GICs, bonds. What else am I missing? Precious metals, a lot of different products available. Options for your portfolio.
That was another question. So someone had a question about options. We did a recent webinar covering options and stuff like that with Options Play. So if you want to check out more information about that, you can head over to the website and to YouTube. And if you go to our Questrade page there, you'll find information about that. You can watch the whole thing or smaller snippets as well.
Perfect. Yeah, definitely recommend checking out those resources, all the fantastic resources offered by Vanguard as well. And just because we're almost at 1 o'clock Eastern here, I will say thank you so much, Surenanthan, and thank you so much to everybody in the audience who attended today. We really value your time, and I hope everyone was able to take something away from the presentation. Any final thoughts, Surenanthan, Adam?
No, I just want to thank you for having me, and I hope this was at least foundational to help people get into investing or just continue their journey. And to what you had said, John, there's a lot of great resources both on Questrade and Vanguard. Feel free to see where that might help you in your investment journey.
Definitely. Thank you again, everyone. And keep an eye out for that post-webinar survey in your Chrome browser. Take care, everyone. Have a great afternoon.